Okay, so welcome back. It's that time of the month again where we talk about mortgage interest rates. That's right. It's the July mortgage interest rate update where we're going to go through all the best full featured and all the best discount rates and tell you the difference between the two, as well as hit some rate specials at the very end and show you exactly what's going on in the mortgage rate environment right now. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers where we're going to give away $5,000 to one lucky subscriber just for subscribing to this channel. They can use the money to put towards their RESP, their RRSP, their TFSA, to pay down their mortgage or just pay down debt in general. But you have to be subscribed to win. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss interest rates for the month of July 2021. I am going to tell you a little bit about some rate specials at the very end, so stay tuned to the end of this. But basically the story right now is that there has been very little change to interest rates. The reason why is because of the uncertainty with respect to whether we're going to have inflation, deflation, or whether prices are going to stay pretty much the same. Because as of right now, depending on the economist you talk to, it could go either way. And we're not really going to know until probably September, October, November, which way the inflation story is going or the deflation story is going. I can tell you as an economist right now that there's a very good chance, especially as supply comes back online, that we could see this not go the way that everyone expects. We could see some deflationary pressure, which means we could see more quantitative easing and lower rates going into the future. But like I said, we aren't going to know until later in the year. And I suspect that interest rates are probably going to be remaining fairly flat, although we'll see some lenders have some interest rate specials throughout the year here. So let's jump into the interest rates, throw you into my computer screen here and show you exactly what's going on. So pretty much last month, we saw interest rates just fluctuate a little bit. The full featured and the discount rates are virtually the same this year or this month with respect to what the normal rates are. There are some rate specials out there, which, like I said, I'll get to the end, but for the most part, we're seeing things stay pretty steady. So 5-year variable rates for full featured mortgages. These are the mortgages that have no restrictions, have all the features. Yes, if you get them from a big bank, they have slightly bigger penalties than if you get them from a monoline lender or a non-bank lender, which we consider to be actually A+ lenders because they typically do the type of lending that is only the best of the best. So if you're going to those lenders, you'll typically get similar 5-year fixed rates to what you get at a bank, but you'll get substantially lower penalties and therefore more flexibility, which can save you money over the long run. You have to keep in mind that just like buying a home, getting a mortgage is a long-term decision, not a short-term decision. We see a lot of people making short-term buying decisions with respect to mortgages based on whatever the lowest rate is, not thinking about what the future holds or not thinking about the level of unpredictability of the future and getting themselves into mortgages that are going to cause them problems down the road. That's why we always talk about full feature mortgages first. We'll talk about discount mortgages later, but most of our clients, I would say out of 100, probably 98 will choose a full feature mortgage this year because, quite frankly, people have gotten more in tune and more knowledgeable about what a full featured mortgage means. So 5-year variables are priced about 1.45%, 5-year fixed for insured mortgages or mortgages with a greater than 35% down. These are the least risky mortgages for a bank or for a lender, are priced at 2.09 for the 5-year fixed. When we start getting into 20 to 35% down, these are the mortgages that have the most risk for the lenders because they don't have insurance on it and they don't have as big of a down payments. And when I say as big of down payments, I mean a big enough down payment that somebody's almost absolutely not going to walk away from the property. And when you start looking at 5-year variable rates in this category, you start to see them range between 1.45 and 1.5%. Now, this is interesting compared to like what January looked like, where we saw this big gap in this 25 to 35% down range. We saw substantially higher rates than the insured and the greater than 35% down mortgages. But now we're starting to see, at least on variables, these mortgages be priced fairly similarly. And that's because, again, with variable rate mortgages, you've got flexible products for both you and the bank, which means they can price them more competitively. Then what we're seeing with 5-year fixed is if you're putting just 20% down, you're paying in the 2.29% range. If you are putting closer to 35% down, you start to get into that same sort of 2.09% range. So think 30% down, you'll be paying 2.09, 20% down, you'll be paying 2.29. Now, moving into discounted rates. So, what are discounted rates? These are the mortgages that have the restrictions. They have the get what you pay for things that come along with a discount. Think about like anything else that you purchase. Typically, if you get a substantially better deal on something, it's because it has less features, is not as good of a product, and so on and so forth. So, this is what those mortgages are. They are mortgages that have restrictions, typically things like no refinance or no switch to a different lender clause, which when you get something like a variable rate mortgage can be highly, highly problematic, because if you ever decide you want to lock in, well, you have to lock in at whatever rate they tell you to, and you've lost your ability to switch to a different lender or refinance to a different lender, and therefore the lender holds all the cards and they get to basically dictate what interest rate you are going to be able to lock in at. So we don't recommend these types of mortgages in two circumstances. One, pretty much anytime you have a variable, but two, is when you're putting a substantial amount of money down, because you instantly lose access to your equity if you no longer qualify at the lender that you got your discount mortgage through. So 5-year variables priced about 0.25% lower than what the full featured rates are. Now, to put that in perspective, 0.25%, if you're a couple buying a typical home in a typical market, is about a cup of coffee a week each, or a glass of wine each, or a beer each, or whatever your beverage of choice is. So we're talking between those two interest rates, pretty insignificant amounts for what you give up in flexibility. 5-year fixed rate. Now, this is probably one of the lowest rates in the market right now, 1.84%. If you are a first-time home buyer and you are just getting into the market and you aren't going to need to refinance, you're putting the minimum down, and you really want a 5-year fixed rate rather than a variable rate, this might be a good mortgage for you with the strategy to get out of it 5 years down the road. Now, putting 20 to 35% down, 5-year variables are 1.2 to 1.25%. Same as last month, and then 5-year fixed are priced at 1.84% to 2.04%, of course, with 20% down paying that 2.04 and 30% down and more paying that 1.84. So, interest rates for the most part have stayed pretty steady. I just want to show you real quickly why these interest rates have kind of stayed where they are, just by showing you here the 5-year bond yield. So here's basically what's happened over the last few months. You see, back in March, we saw this interest rate spike. That was as inflation started to come on board and the bond market started pricing in potential relaxing of quantitative easing and future rate increases over the next 5 years. And basically what they did back in March, at least the bond market, what they did is they said, okay, if we're at 50 basis points now, we expect within a 5-year period that we are going to be at 1% on the 5-year bond rate. Now, this correlates directly to 5-year fixed mortgage rates. So if the bond market believes that interest rates are going to go up by 0.5% in the next 5 years, what that means is that they expect that 5-year fixed rates are probably going to go up about 0.5% in the next 5 years, and then everything is priced accordingly off of that. But here's what I wanted to show you was basically from March until today, this bond market rate has remained fairly flat. And that is because we quite frankly don't know what's going to happen with respect to interest rates. You see, there was a couple times here in June where it looked like inflation wasn't going to be as high as we thought it was, and you started to see these interest rates come down, and then the May inflation numbers came out, and you kind of see these interest rates bump back up, expecting that there's probably going to be higher interest rates in the future because of greater inflation than expected. So you kind of see this fluctuate, but no big moves because there's no clear expectations with respect to what is going on with interest rates and inflation over the next few months. Like I said, we'll see this change. If it looks like we aren't going to have high inflation in the fall, we're probably going to see these interest rates come down. If it looks like we are going to have higher inflation in the fall, then we'll probably see them go up slightly. So basically, what we need to be doing is watching what's happening in inflation in order to determine what our mortgage rate strategy is going to be going forward. Of course, if you're a Mortgage 360 client, we take care of that for you and monitoring the rates and figuring out when the best time to lock in is going to be. We obviously can never hit that perfectly, but we can do it with a pretty good level of certainty and ultimately save somebody a pretty significant amount of money, because when you think about 50 basis points difference between a 5-year fixed and a 5-year variable, for every $100,000 is $500 per year. So if you get a $500,000 mortgage, it's going to save you about $2,500 a year to be in a variable. And therefore, if we know that we've got at least another year or two at really, really low interest rates without an increase. We can save $2,500 to $5,000 before we lock into a 5-year fixed, making that variable rate strategy really advantageous for the right type of borrower. Now, I mentioned that there were some rate specials out there. The one that comes to mind is there's a 3-year rate special at 1.54 with one of our favorite lenders, one of the top 2 non-bank lenders in the country. Again, these are the A+ lenders. They do the best type of mortgages, the insured mortgages. They obviously have to be the best types of mortgages because these brands can't skate on their marketing budgets and their reputations and all of those things. So the mortgages just tend to be better products designed for better clientele. If you're interested in a 3-year fixed because you're just not sure about that variable rate strategy, we think it is a phenomenal option. And if you would like us to have us help you out with it, there's a link in the description below to apply at Mortgage 360. And of course, we know that not everybody can get a mortgage through Mortgage 360. Maybe you've got your own broker that you absolutely love. Maybe it's your brother or your sister or your mother or your cousin or somebody that you absolutely can't get away from. Or perhaps you just want to deal with your own bank, even though we don't recommend that, especially if you're getting a 5-year fix, because quite often the bank that you deal with isn't the best bank to get a mortgage. Take us, for example, we bank at BMO and RBC for our personal and our corporate respectively. However, we always get our mortgages through Scotiabank because quite frankly, if you're going to get a mortgage through Scotiabank, they have a significantly better product than any of the other banks. So we understand that not everybody can come to us, but what we want to do is we want to make sure that everybody has access to the same great information that our clients get, because part of my why is to inspire people to thrive and give. And that means getting you the information you need to make an informed buying decision when it comes to mortgage interest rates. So if you can't apply at Mortgage 360, we have put together a course called Secrets to Getting the Lowest Interest Rate. It is priced so economically that you will get at least 10 to 50 times your money back just by taking that course. It will likely save you from making a really, really big mistake once you begin to understand all of the things that come along with discount mortgages. And once you realize that you can negotiate certain things with a broker or a bank that you may not have been aware of. So I put a link in the description below with a 50% off coupon for that course. That 50% off coupon is going to go away very, very shortly. There have been a ton of people who have joined that course. I sincerely hope that if you are in the market for a mortgage and you aren't going to get your mortgage with us, take that course. It will save you a ton of time. It will protect you from all the landmines and all the surprises that come along with not understanding what you're getting when you go to a big bank and not understanding what you're getting when you get a discount mortgage. And I sincerely hope that you will take me up on the offer to take that course, because my biggest thing is it's going to save your butt. I can almost guarantee it. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video, and don't forget about our race to 25,000 subscribers. I sincerely hope you, especially you, because you made it to the very end of this video, I sincerely hope you will be the winner. We'll see you in the next video. Cheers.